Payrolls report and what it means for the market right now. Dare I say it feels like a Goldilocks jobs report to some extent?
Well, listen, I mean, bull markets are always looking for great news, and we did get some great news out this morning with the jobs report. Taking a step back at Goldman Sachs Asset Management, one of our key views coming into this year is that we were going to see a continued economic recovery. We have a supportive data point out of the U.S. today, but we haven't spent a lot of time this morning talking about recovery in other parts of the world. And what's actually interesting about this environment is we have a synchronous growth recovery covering from Europe, Japan, and also emerging markets.
Yeah.
And that has played out, and for us, very encouraging for the way that we're telling clients to position their portfolios, which is to continue to stay positioned in risk assets. So we continue to like equity over credit and credit over rates, but even within our most preferred asset class, equity, I would say to you that we are warning investors to be cautious, because clearly we're 8 years into a bull market, and the obvious question is, how long can this last?
We caught up with Mike Swad, of course, your colleague, on the fixed income side.
Love Mike.
He pointed out about de-risking and credit, and he was pretty clear about it. Andrew Wilson was as well, and these are guys that I've spoken to over the years that have kept saying, you know, buy credit, and it's changed.
Yeah.
Why is there a story from going to credit and more towards equity? Why is that happening at Goldman?
So I'll never disagree with Mike and Andrew. Love them both very much, and smart guys. What they would say, I think, is that there still is opportunity for credit, but they would encourage people to size positions appropriately and make sure they're getting into quality names. I know that they would tell you we're closer to the end of the credit cycle than when they first talked about it. So we do still think clients should have credit in the portfolio, but be selective. It's just that equity, from a valuation perspective, looks a little bit more attractive. But the reality is everything's expensive, and that's the challenge for investors.
Well, Katie, I'm listening to you. I'm not sure you were disagreeing with Mike Swell, because if you're saying go investment grade, that is a way of de-risking or taking some risk off even in credit. Because I was talking to somebody in private credit yesterday who was saying, boy, the spreads are getting incredibly narrow on high yield, for example. So should people, even in the fixed income area, be really taking a little bit of risk off the table?
We absolutely think people should be moving up the quality spectrum, and that's true in equities as well. I mean, as I said, in the equity markets, we are also very late stage, while we still prefer the asset class.